Sure, that was a great conversation pre-event. So I want to thank everybody for coming today and talking about insurance. My name's Dave Zapponi. I'm the CEO of ECHO, otherwise known as the Educational Council of Homeowners. I want to thank you for participating in Ask the Experts About Insurance. ECHO is a 50-year-old statewide nonprofit association established to support HOA board members and engaged homeowners. Our mission is to foster a better quality of life in community associations through education, advocacy, and connections. For today's event, we have a few housekeeping items. These are now presented on your screen. In addition, slides were sent to registered attendees beforehand. Please take a moment to review our housekeeping items. For today's webinar, we will be conducting two 20-minute breakout room sessions in lieu of a traditional Q&A session. During the breakout room sessions, you will be randomly placed in one of 4 rooms hosted by today's experts. You will then be able to ask your questions directly to the expert. You will also be able to move between breakout rooms if you want to get the opinion from a different expert. Please use the raise hand feature, which is located in the bottom of below the reaction button, if you will, to help the breakout room experts call on individuals with questions. Due to the large audience of HOA board members in attendance today, we ask that you keep your questions short and general in nature, as questions about specific situations are best asked of an expert familiar with your association. The chat icon is to be used to report technical issues and to communicate directly with other participants in the webinar. We will monitor the chat for simple questions. All other questions should be asked during the breakout session. Now, let me direct your attention to your monitor, where you'll find our disclaimer. None of what is said during this seminar shall be construed as specific legal or expert advice from the speaker, sponsors, or ECHO. If you wish specific advice, we encourage you to contact your attorney or another suitable expert. The information we provide during this webinar is educational in nature and should not be relied upon for specific decision-making purposes. I want to thank you. This event, as well as all of our events, is made possible by the generous support of ECHO HOA professional service providers. Join me in thanking today's sponsors. Our premier sponsor today is Silver Creek Association Management, and our gift card sponsor is George Peterson Insurance Agency. Please stay until the end of the program for a chance to win a $50 Amazon gift card. The breakout sponsors today are Spina Insurance Agency, Kirk Miller Insurance Agency, the Kevin Boland Insurance Agency, and Saucer Insurance Agency. And now a few words from Laura Ravazza with Silver Creek Association Management. Connor?
Hi, I'm Laura Ravazza with Silver Creek Association Management. Our core mission at Silver Creek and the touchstone of everything we do is to manage communities with its people in mind. That means we don't just aim to check off standard management boxes, but to listen and cater to the unique individual needs of each and every member of a community. We believe in enhancing the livelihood of communities through our unparalleled dedication to customer service, our ability to offer professional expertise in all areas of HOA management, and our tireless drive to ensure that the communities we take care of are heard, happy, safe, and thriving. We aim to consistently go above and beyond the confines of typical HOA management duties. It's because we genuinely care about how your community functions. We understand that managing a community can be a demanding responsibility, but our team of experts understands how to get things done with efficiency and finesse. Please let us know how we can help you and your community. I hope you have a great education workshop today.
Thank you very much, Laura. We appreciate their support. Please support all ECHO professional members and especially our sponsors. They make our educational programming possible at little or no cost to you. Thank you once again. And now for a little bit about the speakers today. Christy Spina from Spina Insurance Agency has been with Farmers Insurance since 2006. originally learning the insurance industry from her father, who opened the Marin County Agency in 1984. Today, her agency specializes in common interest developments and has worked with over 500 HOAs all over the Bay Area. She was also a founding member of the ECHO's North Bay Resource Panel. Bridget Tabor is with Kirk Miller Insurance Agency and has been a licensed agent for more than 20 years. She started her insurance career in the healthcare industry. Prior to becoming an insurance agent, she spent 20 years working for several large, long-standing law practices in San Diego in the areas of construction defect, litigation, and employment matters. She now specializes in property and casualty insurance with a focus on common interest developments and the construction industry. Kevin Boland with the Kevin Boland Insurance Agency has been a successful farmers insurance agent since 2002. His agency is based in Novato, California. Kevin has 3 important industry credentials: the Life Underwriters Training Certificate Fellowship, or LUTCF, the Certified Insurance Consultant Credential, or CIC, and the Associate in Managing Claims Credential, or the AIC. Mr. Boland graduated in 1984 from UC Berkeley. Kevin regularly writes articles for the Echo Journal and gives HOA insurance talks when asked. He manages the insurance needs of more than 45 homeowner associations, from 4 homes to 400. Kevin also served on his board for 214 homes. He understands the rewards and the challenges of serving a large homeowner association. And finally, Charlotte Allen joins us today as an expert with the Social Insurance Agency. She joined them in 2005. As Director of Education and Industry Partnerships, Charlotte works collaboratively with agents to highlight Social's service, knowledge, and dedication to their clients. Her commitment remains focused on educating common interest developments and their community leaders on some of the most prevalent and challenging issues facing HOAs today. We're ready to begin the program. Christy, you want to begin?
Thanks, Dave. I am really excited to get us going and kicking us off here. Today, I'm going to actually tackle a question that all insurance professionals are being asked daily, probably multiple times a day, and that is, why are my rates so high? Or for today's context, why are my HOA rates so high? And there are definitely some factors that are contributing to where we've landed right now, and we'll discuss some of that. I'm also going to discuss just a couple of things that I think that can help associations be a little bit more attractive to insurance carriers, either their current carrier or to other carriers if you find yourself out there in the marketplace trying to find coverage for your association. So to kick this off, our next slide is what is actually going on. Well, there are a number of different things that are going on. First and foremost, we've had unprecedented numbers and sizes of property and liability claims that have been filed all over the United States. Material costs and labor rates have skyrocketed in the same time period, so it's exacerbating the issue. We've got carriers that are pulling out of California and aren't offering policies here any longer. We have surplus lines carriers that are charging pretty high rates if you're forced to try to work with one of them. And we've got older properties that are struggling to find carriers and get good rates. So with all of this climate happening, we've kind of moved into a supply and demand atmosphere where the insurance companies are high in demand and low in supply. So let's talk about claims and their impact on rates. We all know, and everybody's always worried, if I file a claim, this is going to make my insurance rates go up. So this is This is bigger than that, and that is true. It oftentimes, if you file a claim, you might see an impact to your personal insurance policy. But in the last 5 years, as we all know, we have seen tons of large weather events happening all over the United States, some of them pretty catastrophic. Just last year in 2022, you might recall in September, Hurricane Ian made landfall in Florida and just did a huge amount of devastating damage. Just whole communities really suffering. In California, as we know, we've had pretty much everything except for a hurricane. We've had wildfires and atmospheric rivers and droughts and floods and enormous amounts of snow, all of which are damaging properties in the state. And truly billions of dollars of property damage claims have been being paid out. Hurricane Ian, the estimated amount of property damage done by that hurricane was around $75 billion. In my hometown of Santa Rosa, where I currently live, we've had 2 major fires that have come right directly into town, the Tubbs Fire in 2017 and the Glass Fire in 2020. Those 2 events caused an estimated $11 billion in damage. So these 3 events on opposite sides of the country, 3 events alone have almost totaled $100 billion in property damage. And these claims are being filed and paid for by insurance carriers all over the United States. And things that are happening in other states can and will affect the insurance marketplace and the rates that are being charged in all the other states, including California. We're also seeing a rise in liability losses. It continues to rise with litigious sort of society that we've moved into, and they're not predicting that this trend is going to be any different. We're still seeing large payouts on liability losses, which are directly impacting the rates for umbrella policies, general liability policies, and directors and officers policies. And then again, while all of these weather events have been happening and all these large property damage situations are going on, and insurance carriers are paying out billions of dollars in property losses, we have the cost of materials and labor to repair all of this property damage increasing at the same time, especially our lumber prices. So let's go on to the next slide. And what you'll see here is price volatility for lumber. In this graph, which I got off of the NASDAQ's website, you'll see the price changes and fluctuations of lumber prior to the pandemic. So this starts in 2018, and the graph ends in April of 2022. And you can see that in 2020, when we really, stepped into the pandemic, you're starting to see huge jumps in lumber pricing. We all know that there were supply chain issues that drove a lot of that, but there were also some tariffs that were going on between Canada and the United States with taxation that was also increasing the price of lumber. And we're still very high. It has come down just slightly since the beginning of 2023, but it's still very historically high. So it's still impacting the overall cost of claims when the price of the materials is higher than it's ever been. And then in the next slide, what we'll see here is just an example of the states that have the highest employment levels with construction laborers. California is only second to New York. And I think what I really wanted to show here was the wage that is being paid to these construction laborers. In the construction industry, they're working really hard to try to achieve living wages, just like every place else. We know how expensive it is to live in California. And so wages are going up. The average mean wage in California is $56,000, and specialized types of construction, electricians, plumbers, roofers, it can go even higher. So when we've got labor and material that are both at the highest rate that we've seen in 40 decades, That's definitely also impacting the overall size of claims that are being paid out. So where does this lead us? In the next slide, you'll see that what carriers are trying to do right now is to make up for having had to pay out on all these claims in past years versus what they've collected in premiums. So it's lopsided. The amount of claims being paid out is higher than the amount of premium being collected. And that is not a good business model for any type of business, especially for the insurance industry. Insurance carriers need to have the surplus money in order to pay for the next big catastrophe that's going to come along. And if they don't have it, they're not able to stay in business. They can't be solvent. So we're seeing carriers that are trying to raise rates. And right now we've got admitted carriers, and we'll take a quick stop here. An admitted carrier in California is one who has stated that they're going to follow the rules and regulations set forth by the Department of Insurance. And the Department of Insurance also has to and can approve their rate filings. So whether they want an increase or a decrease in premium, the California Department of Insurance has to approve that. And a lot of carriers are not getting what they want. The Department of Insurance is saying, no, we're not going to give you this rate increase. Many are being told no. Some are being told yes. Some have already filed for these increases earlier in anticipation of these types of things. So many of you may be insured with these carriers, and you're seeing that come across with your renewals, and you're seeing some rate increases because of that. But these carriers that are being told no, they're really in a predicament, because if they don't have the ability to collect the appropriate premium that they need, they can't do business. And so we're seeing that happening. We're seeing carriers pulling out of California altogether and non-renewing customers. We've got carriers that are taking breaks, and they're just not writing new policies right now temporarily. We don't have a real time frame for when that's going to stop. We're hearing between 12 and 18 months. You've probably all heard and seen in the news, State Farm is a perfect example of this. Just last week on Friday, State Farm did say we're not going to be issuing any new policies. They're not non-renewing anybody, but we're not going to be issuing new property and casualty policies. So that's a perfect example of this situation. And then in our next slide, what we see happening with this supply and demand situation that we're in is that if we've got carriers that are pulling out, that really does leave a smaller pool of admitted carriers who are writing insurance for homeowners associations. Not everybody does that. Not every insurance carrier has a product, has a policy, has the coverage that HOAs need. There's a small percentage of carriers who write that type of a policy. So we've got a smaller pool of these carriers that are doing it still, and they are tightening up their eligibility. Oftentimes they are scrutinizing accounts, and they're going out and they're re-inspecting, and sometimes they're non-renewing properties that they think are undesirable. So you might be an association that's been up against that, because we're seeing that happening more and more often. And then, like I was saying, there are carriers that are increasing rates where they can. So we are seeing carriers that are being granted increases, and they are passing that on to their policy holders. Some associations do, in fact, have to turn to excess or surplus lines carriers. And these are what we call non-admitted carriers, and they are the exact opposite of an admitted carrier. They don't have to follow the rules and regulations set forth by the state departments of insurance, and they don't have to have their rates regulated. It's really important to know that it's less important to focus on the terms admitted versus non-admitted and thinking that admitted is better than non-admitted. That's really not the case. Truly, it's the financial strength of the insurance carriers that is the most important thing. And that's what you're seeing. You're seeing these carriers saying, hey, we really want to keep a strong, high financial rating. We want to be able to be a viable carrier and we want to come back into the market. But right now we've got to pull back because we're not going to stay like that if we can't charge the rates that we want to change or charge. So overall, in a very quick, broad, tiny touch your toe into the topic, these are the things that are really driving rates up right now. These are the trends that we're seeing. It's really claims and cost of materials right now, and carriers not being able to charge the rates that they need to charge. So let's transition into the next slide, which is what can associations do to make themselves be more attractive to either their current carriers or other insurance carriers. If you find yourself out in the marketplace and your broker is working to try to help you find coverage elsewhere, and they're working hard, trust me, we're having to be very clever about what we're doing in a lot of cases right now. So first and foremost, I think one of the best things an association can do is try to avoid filing claims. And I know that that sounds really easy. Things happen, claims need to be filed. I think that I'm going to address those associations that have a responsibility to ensure the interiors of their units. And I know that Bridget's going to touch on this when she talks about her portion. She's going to go a little deeper into this. So I think that might help you understand that a little bit more. But if you're unsure whether your CC&Rs state that you have the responsibility or the association has the responsibility to ensure the interiors, get your CC&Rs and get together with your insurance professional and they'll be able to help you understand that. But trying to avoid filing claims by either increasing your deductible. Lots of associations are still carrying low deductibles, $2,500, $5,000, even $10,000. I would consider that to be borderline low. Get up there and increase those deductibles, $25,000, $50,000, even higher if you can, and really try to drive those claims away from the association's policy and over to your unit owners' insurance carriers. The unit owners can insure for that, which will also be talked about in more detail in another presentation, or even considering updating your CC&Rs altogether. Maybe take out the language in the insurance section that says it's the association's responsibility to insure the inside. Give all of that responsibility to your unit owners. They can insure for that. And again, you're driving claims away from the HOA's policy and to the insurance carriers for your unit owners. And then next and last is, what about the older associations? These associations are really having a tough time right now, especially if they have to find other insurance, they get non-renewed or something happens. What I'm seeing is that carriers are really looking to see when certain components have been updated in these older associations. And by older, I'm talking like 20 to 25 years, which doesn't really seem that old, but to the insurance companies it is. They're looking to see updates on heating, electrical, plumbing, hot water heaters, roofs, if that's the responsibility of the unit owner. And a lot of times I'm coming into a situation with associations where they don't have records of any updates being done because the association doesn't do the updating. The unit owners are doing the updating and they don't have a collective census of when things have been updated. So a recommendation would be for boards to send a letter out, ask your unit owners to respond to the survey letter, asking them to let you know when they have updated these components. Once you've received all of those back, you can compile that into a spreadsheet or give it to your insurance broker. They'll be so happy that you have done that, I promise. And they can put the spreadsheet together. And if you can show that a majority of your association's units have been updated, then you have a good chance of finding more carriers, offering you quotes, and potentially giving you the best rates that you can find. And with that, my time is up. So I'm going to hand it back over to Dave. Dave, you're still muted.
Yeah, could you, Bridget, go ahead and start your presentation, please?
All right, thanks, Christy. Next slide. So I'm here to do a high-level overview on insurances. We will have time in the breakout for more detailed question. I can tell this is really anxious crowd. I'm looking at all the great questions. I'm going to talk about the property coverages first, and then we'll get into liability. Next. So you hear all the time people talk about walls in coverage, and walls in is something that you get mixed feelings. Some associations, you know, they have their CCNRs. A lot of them are written with walls in coverage. So it covers not only the common area, but it covers whatever is on the inside of the unit and those things that are attached to the condo. So typically attorneys will say, when you turn it upside down, everything that sticks to that unit is covered on walls and coverage. If it falls loose, it's pretty much your personal property, your TV. Now, although this type of insurance is preferable for most associations, it can be more expensive than the bare walls. And then that will in fact impact how much you have to increase your assessments. Next slide. And when you have walls in, there's different types of wall in coverage. What you'll usually see is what we call the single entity, which is you're going to insure the inside, you insure it as it was built by the developer, and it does not include upgrades. Now, the unit owner does not have to purchase any building coverage, but if you have upgraded your unit, you know, somebody flown some expensive tile from Italy, that's not going to be covered under the single entity type of coverage. Next. A lot of associations through their CCNR amendment with their attorneys are going to the bare walls coverage. And the bare wall coverage means that the unit owner is responsible for ensuring the things that are inside the unit, whereas, you know, if you turn it upside down, the cabinets and stuff that sticks to it, the unit owner is now covering that, including the floor, the walls, the partition walls, cabinets, fixtures, and all that stuff. So the master policy is just going to ensure the structure, and it'll come into the unit to the drywall pretty much. There are slight variations, and you have to look at your CCNRs to be sure what that definition of bare walls is, but in general, that's what you're looking at. Next slide. Now, the bare walls concept has been around, but there's been twists that have been added to it. And right now, the one that I'm seeing is the one that says studs out, which is really more restrictive than bare walls, because a lot of times with the bare walls coverage, the electrical and the wiring and all that stuff will be included. I have recently seen some studs out, which may or may not include elements to be insured that you would think would be insured. And a lot of times homeowners, board members get together. I was my board president for 12 years. And so when you're going through claims, they're saying, well, my carrier didn't cover this and my carrier didn't cover that. It's not just the carriers, it's the coverage or what's written in the CCNRs. And as agents, we write coverage based on what your CCNRs require. And a lot of CCNRs, as you know, is very, very vague. And a lot of times we will ask the board, how do you want this insured? Or we will work with the association's attorney to determine how the coverage is written. But understand that our writing the coverage is based on the CCNRs and what we get from legal. It's not something that's really determined by us, the agent, or the carrier. Next slide, please. Now, the unit owner's coverage, when you're looking at a bare walls policy or you're looking at a studs out policy, you will have an HO3 or an HO5 policy. And you will see these types of policies more with what we call plan unit developments, where each home sits on its own individual lot. And HO3 and HO5 are very similar. The HO5 covers more, and it covers more on the personal property. It comes at a higher premium, but this is where the owner is actually insuring their structure. Whereas with an HO6, which is on the next slide, or I don't know what happened to the slide, but the HO6 policy is the policy where most HOA members will have, where the master policy will cover the structure and the unit owner's coverage, or the HO6, is being paid for by the homeowner. And I strongly recommend those who rent out their units require their tenants to have an HO4 policy to cover their own personal property. The other reason I like for owners who rent their homes out to sit down and go over their agents, a lot of carriers, when they're writing the coverage, they're assuming on an HO6 policy that the owner is living in that unit. If you're not living in that unit, then you should notify your agent, because that will change how much is available and how much the carrier will pay at the time of claim. And so the renter will have a renter's policy. The other reason to have an HO6 policy is because the HO6 policy will give you things that's not covered by your master policy. Additional living expenses if you have to move out, loss of use if your renter has to move out, or loss assessment coverage if there's a special assessment and the association has to do a special assessment to cover a loss for the whole community. Those things, and I get calls all the time from unit owners saying, I asked my board, to file a claim because I had to take my renter out, or I had to live outside my unit. That's not going to be covered under the master policy. That's a coverage that you have to have as an owner to protect yourself and to protect your income, especially if you're renting your unit out. Next, Connor. So now, after talking about the property coverage, now we're looking at casualty coverage, and the casualty coverage is doing the same thing from a liability style, where that's where we get the name property and casualty coverages. So the first casualty coverage that I'd like to talk about is the directors and officers. And in my mind, this is the most important coverage because you all are volunteers. I was a volunteer. We're learning this. Nobody really taught us how to do this. And we have a lot of things that, we could potentially have exposure on, our personal assets. So the Davis Sterling early on made it very clear that, everyone should have this directors and officers coverage. I can tell you there's 2 times a board will be sued. Something they do or something they don't do. And as Christy already said, litigation costs are rising. We're a very litigious society. And as you can see from the things on the slide, you're doing what you were volunteered to do, which you were assigned to do either by the California Corporations Code, by your CC&Rs, or by the Davis Sterling, which is enforcing the CC&Rs, placing liens on things, taking care of common area maintenance. And if you are sued for doing your duties as a director, as outlined in the bylaws, and not acting as part-time handyman and different things that some board members like to do, that's what this policy is for. It will cover you in case that you're sued by a vendor, another homeowner, or a visitor that's coming onto your property. This policy will not give you the ability to sue someone else. And I think that's the one thing a lot of homeowners and board members aren't clear on. So it's kind of a defense-only policy. So you cannot say, well, I'm upset and I want to sue an owner. The association's policy will not afford you the ability to sue someone. It will only provide defense costs. Next slide. Now, I was mentioning the Davis Sterling, and they have a requirement that if you're over 100 units or under 100 units, if you're over 100 units, we usually recommend boards have at least $1 million of directors and officers coverage. Always check your CC&Rs, because if your CC&Rs or your bylaws require a higher limit, that's what you should do. The Davis Sterling usually focuses on the minimum. If it's under 100 units, some boards only carry 50,000 in coverage, and that's fine. You can choose whatever you want, but you're meeting the minimum requirement. The most important thing that I want everyone to remember on this is if a volunteer or director owns 2 or more separate interest units, 2 condos, 2 homes, whatever, you are not protected by the directors and officers policy, because now you are considered an investor and not a voluntary homeowner director. So can you get other coverage? Yes, you can, but under this policy that most association boards have, you will not have that added protection of your personal assets. Next. Now, the second most important policy in my mind is your commercial crime policy. And simply stated, that just covers your association funds, those sitting and operating and those in reserve. And back in January of 2019, there was a mandate that all associations carry this coverage. Prior to that time, there was a lot of associations who did not have this coverage. And again, there was a minimum set by the Davis Sterling that your reserve funds plus 3 months of your assessments is what is required to be covered. Also, for associations who are looking to do, they have owners who might have a government loan, FHA, VA, they also look at these limits. And you may, have a new owner coming to buy into your association, and they'll contact the board or the management and they'll say, well, our bond limit is too low. And there's a Fannie Mae, Freddie Mac requirement that we have to take into consideration. And a lot of times we get a little pushback from boards that's saying, why is our bond limit so high? It's not, again, our desire to over insure you on your finances, but we have to follow state and regulatory laws that have been put in place, and it protects the memberships. And everything that we do is to protect the membership, because you have 5 directors and you could be in a community with 3,000 people. And we work with you to educate you so that you can educate your other members and homeowners so that they understand why we do what we do on the insurance side. Next slide. Now, in 2022, this section was amended to add that there is protection for computer fraud and funds transfer fraud. I'm sure all of you have heard things in the news, whether it's through malware or social engineering or all these things that come up where monies are stolen. And the banks will not cover these losses, especially when it comes to wire transfers. You have to remember, as a homeowners association, you are a corporation. And while those things could be covered as you as a personal individual with your bank, it will not be covered by your bank if you are considered a corporation. 15 years ago, banks were offering protection, but banks have been losing so much money to fraud and social engineering that they have decided, we open a Pandora's box. It's gone for commercial, and it will probably soon be gone on the personal side because of the catastrophic losses that banks are experiencing now. And a lot of owners saying, I have a crime policy, why do I need a cyber policy? So the crime policy will cover and replace monies that's lost. But if there's a cyber loss, there's a lot of other damages and expenses that's associated with that loss. So most people remember the Target incident. So you have to send out letters.
So Bridget, I'm sorry to interrupt. I know you have about 6 or 7 more slides, but we're getting close on time. I just want to give you a heads up on that.
Okay. so anyway, you have a cyber loss, which is different than a crime loss. So we'll talk more about that in the breakout room. Next slide. The one everybody's familiar with is your commercial general liability. This is mostly like the trip and fall, stumbling over a tree. I think most owners understand this. Again, the Davis Sterling has set requirements for 2 million coverage if you are under 100 units and 3 million if you're over 100. Next. Then your excess liability and your umbrella, these are not interchangeable. Board members get confused. An umbrella provides extra insurance that expands coverage. An excess liability policy is one that follows your underlying policy, your underlying general liability policy. And so with your umbrella, you actually can have more coverage because there could be coverage afforded by an umbrella policy that is not covered under on your general liability, but on the excess liability side, it's what we call fall of form. So if it's not provided, coverage is not provided under your general liability, it won't be provided under your excess liability. Next. And finally, workers' compensation, and this is a big one for boards. Why do I need to carry it? For unlicensed and uninsured vendors, we kind of talk about that all the time. There has been lots of lawsuits about workers' compensation. And go to the next slide. There was a very famous case, Hyman versus Workers' Comp. This HOA hired a contractor, and the contractor was hired to clean rain gutters. The employee was careless. He was electrocuted. And then what happened? The contractor that was on the job did not have workers' compensation insurance for his employee. So the state said, well, then the association and the management company is that person's employee. And they were the ones that end up having to pay this employee's workers' disability till age 65. Next slide. So the last thing boards do get a little confused on is, we have this workers' comp policy. It's a zero payroll workers' comp. So it's not like you would see in other businesses. But the one takeaway here, again, I think is you need to make sure that you understand that this policy will not protect you as a director or volunteers if you're acting in your capacity as a committee member or a homeowner board member. Thanks very much, and I look forward to seeing you all in the breakout room.
All right, that's called a smooth start. So if anybody wants to stretch, it's not going to bother me, so please feel free to do so. I know you've heard a lot of great presentations from my competent colleagues in the business. So my specialty has been homeowner associations for a long time. I insure over 52 associations today. I have a great team. We deliver great service, and I'm really passionate about it. So I promise to make my presentation crisp, clear, and to the point. And I might tell you something you might not want to hear, but I'm going to tell it to you anyway. Okay, next slide, please. So let's take a quick look at California earthquakes. Seismologist predictions, there is and this is for Los Angeles County only, 60% probability that an earthquake measured a magnitude of 6.7 will occur. There is a 46% probability that an earthquake measuring a magnitude of 7.0 will occur. And there is a 31% probability that an earthquake measuring a magnitude of 7.5 will occur. And that is just the county of Los Angeles. I don't know about you, but 6% seems awfully high to me. So can we transition to the next slide? Thank you, Connor. So that was Los Angeles. How about the greater San Francisco Bay Area? Well, there is a 72% chance of an earthquake measured a magnitude of 6.7 that will occur. And you can look at the other statistics as well. So if you recall, Los Angeles only had a 60% chance. In the Bay Area, we have a 72% chance of earthquake. So I don't know about the rest of you, but after I did my research the last few days, I had a hard time sleeping at night. And maybe a little shake, it actually made me think of an earthquake. Next slide, please. So why is it that California and Los Angeles and San Francisco Bay Area in particular are most at risk for earthquakes? Well, there are two main reasons. One is called the San Andreas Fault System, and the other is called the Roger Creek Fault System. And they happen to run right up and down California. And if you look at these fault lines, try to figure out where your association is next to them. And if you are on top of that epicenter, then I hope you have earthquake insurance today. One of the facts that was startling to me just a few days ago when I read it is that the San Francisco Bay Area has the most likely possibility of having to sustain severe earthquake damage in the event of an earthquake. And that's because the San Andreas Fault in Northern California straddles the two biggest tectonic plates in the United States, the Pacific tectonic plate and the North American tectonic plate. So again, when I looked at these statistics and I read what the geophysicists and the seismologists are saying, it kind of was a wake-up call. And I don't know if you can see it on the screen, but in the ocean there, I'll read the text here that's smaller font. It says the total 30-year, no, it didn't work, Connor. Make it, I can't see it. Okay, thank you. The total 30-year probability of one or more large earthquakes for the entire region is a 67%. Now, I don't gamble, but I go to a casino once every 5 years and lose my money. I would love to have a 67% chance of winning, but it's not going to happen. So I hate to repeat the old adage, but it's really not a question of if an earthquake is going to happen, it's a question of when. Okay, let's transition to the next slide. So I wanted to give everybody just a quick refresher, and a wake-up call to the fact that if you look at the science, we are going to have another big earthquake, either in Los Angeles or in the San Francisco Bay Area. So now let's take a look at the insurance policy and how it works. So your typical deductible for earthquake insurance is anywhere from 5 to 25%. And I think, like my colleague Christy said earlier today, I was surprised in the last 2 years how many associations actually had smaller deductibles. And for whatever reason, the broker never said, hey, you could save $5,000 or $10,000 by simply upgrading from a 5 to a 20% deductible. And I've done the math a couple of times. If you spread out the cost of the deductible by the amount of homeowners that have to chip in and pay for it, to go from 5, 15, or 20 is really not that much more out of pocket for the homeowner. And at the same time, you're saving your association about anywhere from 10 to 20% each year on the premium. So consider that, board members. Take a look at your deductible for earthquake insurance, and I would recommend you get it about 25%. Now, every earthquake policy has a minimum deductible of either $25,000 or $50,000. That's the way for the earthquake insurance companies to make the association pay for minor damage. And a big difference between fire insurance and earthquake insurance is that your deductible is per building. So if you had one major wildfire in your association, you would only have one deductible to pay for all the damage. However, with earthquake insurance, it's by building. So let's say you have 3 buildings. Each building sustains $1 million in damage. That's 250,000 times 3. I'm sorry, 250, 250, and 250. So you're looking at about $750,000 in deductibles. Ouch, that is a lot to pay. Again, it's one of the reasons people don't buy earthquake insurance is the deductibles are really high, it's expensive, and lenders don't require it. And sometimes and often the CC&Rs don't require it as well. Okay, next slide. Thank you, Connor. All right, so what does the earthquake policy cover? Well, it covers the buildings, the foundations, utility lines, and other structures, such as the clubhouse, utility structures, gazebos, tot lots. It's always important to get building code and ordinance coverage. Most good earthquake companies that provide insurance today will do that. And it's also good to get some lost income if you can as well. At my agency, we only represent 3 earthquake carriers. Insurance Group of the West, which is the best financially insurance company to have because they're the only one that's A-rated. And then we use Palomar and we use Aegis, and they're both A- rated. I would never use anybody less than that because, as we know, when the earthquake hits, it's going to cost a lot of money. So you want to make sure you're with a solvent company. And I would definitely recommend board members one of those 3 companies. Okay, next slide. All right, so what are some of the reasons for not buying earthquake insurance that you're going to hear from your membership? Well, it'll never happen to me. It hasn't happened in 100 years. It'll never happen. Well, that's like saying you're never going to die. You know, one of the products that I've been selling for 20 years at my insurance agency is family life insurance. So I've had probably over 300 policies sold over 23 years. And trust me that I've handed out insurance checks to a lot of spouses that were really happy that they had some insurance in place. And either the husband or the wife thought it would never happen to them before the age of 50 or 60, but it did. So that argument doesn't really hold water. It's too expensive. That argument holds water. It sure is expensive, and that's the drawback to it. And the third reason is homeowners will never vote for it. Well, that's not true either, because I've seen a number of associations get earthquake insurance, and I have a number of them today that have it. And like a lot of other decisions that we as board members have to make, is typically our decision. And we typically get my association is 214 homes, and we typically get maybe 5 or 10 homeowners that actually show up to the meetings on a regular basis, participate. They trust the board to make the decision, and quite frankly, they're just too busy in their own lives to get involved with it. So I think you'll probably come across 1 or 2 owners that'll say, hey, it's too expensive. It'll never happen here. But you know what? As board members, we need to stand up and say, yes, it will happen here. And look at the science. There's a 67% chance of an earthquake hitting California that's large by the year 2032. That's huge. So don't tell me it'll never happen here, that you're going against science. So, you know, we have to stand up as board members. We've all had difficult battles, I'm sure, in the past. I know you have, because I'm a member of the board member group. So sometimes we just have to stand up to those homeowners that try to say that. Okay, thanks, Connor. Next slide. So I've already mentioned it's a 67% chance, but that's a big statistic. I wanted everyone to take that away today. Is it worth protecting our equity? Well, I'm in my 60s. It took me 30 years to build what I have today for my daughter and my wife, and she's worked hard for 30 years as well. I don't want to lose my equity to an earthquake. So for me, a couple $100 a year, 5 or 6 or whatever the number is, it's well worth it to protect my equity. And I can pass on a legacy to my daughter. So insuring for less than a total loss, a different approach. Earthquake carriers allow for insurance to be less than total replacement cost. So here's something that I discovered a lot of boards weren't aware of for whatever reason. Again, they weren't advised prior. But with earthquake insurance, you can insure for less than the total value. If you have fire insurance, you have to insure for the total value. So next slide, please. Thank you, Connor. So think about insuring for 80 or 90% of the replacement costs for your associations. And I'm going to say this with a grain of salt because I'm an insurance agent. So my job is to tell you, spend a lot of money, over-insure. That's the best way to be. If your association is on top of or within 30 miles of an epicenter, you definitely want to insure for 100%, no doubt about it. But if you're further away from the epicenters where the fault zones are, the Rogers Creek and the San Andreas in California, then think about insuring for 80 or 90%. And it's a decision you have to make as a board. It's going to be a tough decision, a tough discussion to make. You'll have a lot of strong opinions, pro and con. But I always think it's better to have something than nothing. And the only reason I would even recommend insuring for less than total value is because I've seen a lot of associations, or a handful, cancel their earthquake insurance this year, or go into their CC&Rs and write an amendment saying it's no longer going to be required. And the reason they're doing that is because the rates are so darn high and everything else has gone up, as my other colleagues have enunciated clearly today. So that's the only reason, that's my caveat. But I would encourage the board members, if you're looking to really save some premium, consider insuring for 80 or 90%. And I think it's a different approach, but I think it's one that as board members, you should A, be advised about, and then B, discuss it. Okay, I think, let's see. Yep, I think I made my point pretty well. Next slide. So here's the earthquake insurance policy. Let's say you have $10 million in coverage and it's a 100-member homeowner association. Your premium is $20,000. Divide 100 into 20, you get $200 a year or $16 a month. So for that homeowner that says he can't afford earthquake insurance, how much do they spend on coffee? I spend a lot of money on coffee because I'm traveling all over the Bay Area. So I go to Pete's, Phil's, and Starbucks. They're my 3 favorite places to go. And I spend $30 a month on coffee. So I really think it's that argument, again, doesn't hold water. And don't let a homeowner lead other homeowners into thinking it's too expensive. Look at the facts and look at the numbers. I think it's well worth it when you're protecting your home equity. Okay, next slide. So my recommendations for everybody: protect your home equity, get earthquake insurance. It's not a question of if, it's a question of when. Going back 34 years since the Loma Prieta earthquake, $6 billion in damage, 63 people died. The San Andreas fault lines, the epicenter was 56 miles south of San Francisco. And look at all the damage that occurred. The next big earthquake will happen, and the probability is before 2032. So that is my recommendation today. Thank you, everybody. If you have more questions, you know how to reach me. Always call me or email me. And I'm glad I could offer my opinion today. And thank you very much for attending.
Perfect. Thank you so much. And Charlotte Allen, you want to give us your little presentation now?
Absolutely.
Mhm.
Hi, everyone. I'm Charlotte Allen with Sociure Insurance. We are going to talk about wildfire insurance. I know that's kind of on everybody's radar right now, and I'm going to get a little bit into the California FAIR Plan. I think it's only fair that we talk about it because there's a lot of rumors flying around, and I want to put some of them to rest. So let's start with our first slide. So I really appreciate that Christy led us into understanding the hard market that we're finding ourselves in. And she really looked at us as an entire nation and the claims that we've seen. But because I was asked to talk about wildfire, I want to focus solely right now on the wildfires that we've seen throughout California. And more than half of the 20 largest fires in California history have happened within the last 5 years. So, I mean, this is just a map that's showing you the amount of money that has gone towards claims for those fires that we have seen. Next slide. So about 75 communities within California have actually been deemed the most prone for severe wildfire damage. What these experts are basing this on is one, fire history. So, you know, how many fires have we seen come out of this community in the last, 200 years? Really the topography and wind patterns. And that was one aspect to the fire mapping and determining how dangerous these communities were the wind patterns. I personally live in a community that is not surrounded by heavy brush. I have absolute clearing around my home, but I am considered a high fire danger. And I found out that the reason for that was one, wind patterns that they were following and how embers could eventually blow into my community, but also means of egress or ingress. So how easily can community members get out of that area if wildfire hits? And sadly, I live in a small city where there's really only one way in and one way out, and that is taken into consideration. I want to be clear, though, just about anywhere in California, there is a potential for fire, obviously. Wildfire, again, it's not necessarily looking at just those high brush areas, but taking into consideration all of the components that could put you in harm's way if a wildfire were to hit. Next slide. So this is a copy of the mapping that insurance companies are following. It does change. We as insurance professionals follow this and constantly are taking a look at the fire mapping. But this is a nice visual that you can kind of see where the most dangerous areas and probably those 75 communities that I mentioned are located. Insurance companies are looking to this fire map to determine and give every community a fire score. And what we're finding is that insurance companies, where they used to have a lot of flexibility and what I used to like to call negotiation capabilities, they're having, kind of drawing their line in the sand and saying, hey, if you have a higher score than X, we will not insure you. No questions about it, no room for negotiations. Times have certainly changed, and this is all part of that hard market that we're experiencing, but this is specifically in regards to wildfire and wildfire danger. Next slide. Okay, so the current situation for high fire danger zones, and again, I know that we're quick to talk about wildfire, and I think for Californians, we assumed that when the hard market hit, it was all because of these wildfires. And because that's what we see, right? We live in California, we see the claims that are coming up in California. We're not always necessarily paying close attention to the polar vortex in Texas. We're not paying attention to the hurricanes in Florida and things like that. But I'll tell you, these insurance companies insure homeowners associations in all of the states. And so they're paying claims all over the country, and things that happen in other states absolutely affect what they can write in California. I'm going to be honest, I think that we were quick to say, it's the wildfire that's the issue. It's only the wildfire communities or the communities that are in severe danger of wildfire that are seeing these non-renewals from insurance or high premium increases. And as Christy shared, it's other communities. It's these underwriting guidelines are coming down, and they're coming down strict on everybody, not just the high fire zones. For instance, our agency, we write over 2,500 homeowners associations in Northern California alone, and about 4% of our entire book has been non-renewed or seen a major premium increase because of wildfire. Now that is going to be so different in Southern California, I have to suspect, but our specialty in California is NorCal. So about 4% of our book has been non-renewed because of wildfire reasons. Your fire rating is too high. They're really scrutinizing. And so what we're seeing is insurance companies either offering a very limited amount of insurance for those high wildfire areas, or unable to write insurance for them at all and forcing them into the non-standard surplus lines market, which Christy was so great at explaining. And I really liked what she mentioned. And I want to be clear, surplus lines is not new. It's just different for most of our associations, because for the last 15, 20 years, we've been in what we call a soft insurance market. And we had all kinds of insurance carriers that were willing to write all of your associations. In fact, so many of them were being competitive neck and neck with each other. And it was a great time for you as the insured to find the most competitive premiums and the broadest coverage. Because we're in a hard market and we're in this supply and demand issue, a lot of you or several of you have been forced into the surplus lines market. I don't want you to be afraid of the surplus lines market, but I do encourage you to work with professionals that understand those policies and their exclusions, and we'll work with the association to make sure that we're getting the most robust policy for your association if you find yourselves having to dip into the surplus lines market. Next slide. Have a good one. One other thing I want to mention too is our goal as insurance professionals is to keep you out of the surplus lines market, because we know you're paying more for it. So if you find yourself having to go to the surplus lines market, as insurance professionals, we want to quickly get you out of that surplus lines market. So if there are things that the association has done to make themselves more desirable to insurance companies, we still want to share that information. And although long gone are the days of negotiation, and these hard lines are being drawn in the sand, we still want to collect all of that information so we can share that with insurance companies. We hope in the insurance industry that these things, becoming a fire-wise community, cutting back brush, doing the right things and maintaining the property will once again very much matter to the insurance companies. So please don't stop those conversations with your insurance professionals. As an insurance professional, I want to tell you, none of us have given up. We don't want you to give up either. I've been with Social Insurance for almost 18 years. This is my first experience in the hard insurance market. I remember everyone around me telling me it's going to happen. It's cyclical, which is true. I've read, actually, it's about 1,500 pages, but I've read the history of insurance. It is cyclical. The hard market will come and it will go. We want to pay attention to what's going on. You want to work with professionals that are following the fire mapping and following what insurance companies are doing. We are advocates. We have groups of insurance professionals, homeowners, board members, some of you in this quote unquote room today that continue to work alongside the California Insurance Commissioner, Ricardo Lara. Ricardo Lara, we are in his ear. He has been working with us and hearing our stories and bringing these stories forward to the people that matter and the people that make these decisions. So I want us to continue to be advocates for ourselves. One of the results that came from that pressure to Ricardo Lara and the Department of Insurance in general was increasing the FAIR Plan limits. So I'm going to talk a little bit about the California FAIR Plan. I want to be clear, it is a last resort option for insurance. So if you cannot find insurance anywhere else, including the surplus lines market, if you cannot find insurance coverage, you can get coverage through the California FAIR Plan. Because it is a last resort, or I should say it is a last resort because it is very, very basic coverage, it is incredibly limiting. And up until recently, they could only give up to $3 million insurance policies. So that did not help most, if not all, of our homeowners associations. Because as you can imagine, unless you're a very, very small homeowners association, your price to rebuild far exceeds $3 million. Recently, and I'd love to say based on the pressures that many of you in this room were forcing upon Ricardo Lara, the FAIR Plan gave a little bit and they were able to increase their limits to 8.4 million. Now, again, I want to point out, I would say the average homeowners association in our book of business is about $15 to $20 million to rebuild on average. So 8.4 million still may not offer you the coverage that you need as a homeowners association. So this is not perfect science. This is not our first choice by any means, but I want to be clear, it is out there and available. If you are finding yourself in a position where you cannot find insurance, talk to an insurance professional about looking into the California FAIR Plan. More information to come. They are considering raising those limits again. Again, it's just not the most ideal policy. Next slide, please. Okay, so we're also working hard to find coverage, and let's erase the FAIR Plan from our minds. We're looking at those California admitted companies first and foremost, and then we're looking to those surplus lines markets if we have to. We're keeping an eye on the maps and how they change, following state guidelines and the news, of course. And we're also more than ever collaborating with our friendly competitors. So, the insurance professionals that have joined me on this panel, oftentimes we are working together. If I can't find something for you, I am more than willing to pass you along to another insurance professional that hopefully can. We are working closely to try to find the best coverage for our homeowners associations. You want to work with a professional that understands the insurance carriers that are in our market, both those insurance carriers that are leaving the market and entering the market. Again, bad news, if you will. State Farm just announced they're not writing any new policies in California. I do fear that may happen for other insurance companies. However, you want to work with professionals that are really paying close attention to that. And know this, that there are often new insurance companies that will enter a market. Maybe there's an insurance company that really put a lot of their book into Florida and they want to enter California. We are paying close attention to those insurance companies. Next slide. Oh, all right. I did it. I got through my slides. Thank you. Oh, Dave, you're on mute.
You're muted. Dave.
Thank you so much, Charlotte. That was excellent. We appreciate your time. Let's go ahead and move to the breakout room. Okay, I think everybody's getting back in here. Nice to see everyone. Thank you for staying for the duration here. I want to say thank you, of course, to everyone for coming today. I want to say thank you to the ECHO members for coming today and supporting our ongoing ECHO webinars. This is our third annual Ask the Expert About Insurance webinar. We'll have it next year about the same time. Look forward to having speakers continue to offer their expert advice. For those of you who are joining us today but are not members of ECHO, we invite you to become members of ECHO. You can, you or your community can join by going to our brand new website at www.echo-ca.org and clicking on the membership tab. For ECHO members, thank you for supporting us, and please invite your friends, boards, and especially management firms and vendors to join ECHO. A simple invitation is often all it takes to encourage a new member to join. Please help us grow ECHO and continue to provide our excellence in HOA education. If you would like to become more involved with ECHO, we have a few opportunities for you. Please refer to the slide. If you see anything that looks interesting, please let me know at Dave Zapponi, d.zapponi@echo-ca.org. Currently, we're looking for volunteers to help us with our in-person events and especially our resource panels and educational seminars. And we would love to have some help with social media posts as well, and following and liking our social media as well. Now on for the other announcements that we have. Our Wine Country Resource Panel will meet on June 6th from 11:30 a.m. to 1 p.m. at the Rohnert Park Library. We hope to see you up there, and we'll be discussing the cost and types of insurance there again. So interesting. The next ECHO Board Members Club meeting is June 13th. It meets via Zoom every second Tuesday of the month from 5:30 to 7 p.m. Tentatively, the topic of the meeting is developing board member expectations and codes of conduct. The BMC, or Board Members Club, meeting is open only to members of ECHO who serve or have served on their HOA board. These highly interactive peer-to-peer learning forums are scheduled for from 5:30 to 7 p.m. and are Zoom meetings. Please contact Connor at echo-ca.org to learn more about joining the Board Members Club of ECHO. Once again, thank you to all of our sponsors for making this workshop possible. Thank you to our insurance experts for participating today. And of course, thank you to all of you for attending today and making this an event a success. ECHO appreciates your investment in education to foster a better quality of life in HOA communities. And now on to Connor, who I believe has a few closing announcements. Connor?
Hello, everyone. Just a couple more here for those of you who are remaining. We do have a gift card to give away, and I'll be doing that in just a moment. I do want to remind everyone on the call that all the general sessions for today's presentation were recorded and will be provided for you to go back through and get some of that information that you may have missed, or to bring it to your community. So just look next week towards the middle of the week for a copy of the recording. Also, just a reminder, if any of the insurance experts here, if you want to reach out to them, give them a call, maybe get a quote from them for your own communities, all of their information was provided in the slide deck. That slide deck was sent prior to today's meeting. If you need a new copy of that slide deck, you can shoot me an email and I'll send it to you as well. But if any of them you want to continue this conversation offline, their information's in there. Make sure you get it from there. Before we head into our upcoming webinars, I'm going to go ahead and do the raffle. So give me just a moment here to do that. This raffle is courtesy of George Peterson Insurance Agency. So thank you to them for providing that. And here we go. Okay. And the winner of today's raffle is Eugene Smith. Eugene, if you're here, if you could go ahead and type into chat or unmute yourself and just say here for me, that would be great.
You must be present to win.
Give them a couple more seconds here.
I do see that he's still logged in to the meeting.
Yep.
He's just muted.
I see him logged in. Okay, well, if we don't have confirmation, I will go ahead and do another drawing here. Okay, the winner of the redraw is Nancy Kemper. Nancy, if you're here, if you could unmute your mic or type into chat. Everyone went to lunch early or late today.
You're still logged in.
Nancy's there, but she's muted.
And I don't
Nancy?
see anything in chat as well. So it looks like we get to go to a third time. Third time's the charm is what I hear. Okay, and the winner for the third try is, oh, I'm going to butcher this name and I apologize in advance. Cuneo Molianor. I think I butchered that, but
You called my name?
perfect. Someone responded. Well, congratulations. You won our $50 gift card.
Oh, cool.
Well, thank you for staying until the end, and I'll go ahead and send that over to your email address that you used to register for today's event.
Oh, cool. Thank you.
Congratulations. With that, just a couple remaining things. It's been on the screen this entire time. We have some upcoming webinars that may be of interest to you. This weekend on Saturday morning, we have our Ask the Attorney. This is our circuit of Ask the Attorney series. This is the second installment. This one, we will be going over laws other than the Davis-Sterling Act. So these are civil codes, corporations codes, some federal laws will be included in there as well. It's a really good event, especially if you're a new board member, to know some of the things that affect your community. Other than that, we will also be doing our case law update tentatively. That will be on June 27th. So we look forward to seeing you there. And July 6th, the week of 4th of July, we're gonna be tentatively doing an elections webinar as well to help all of you that head into elections at the later part of the year. And with that, our last announcement, we have our first in-person educational seminar. That will be on June 24th. This is in Campbell at the Campbell Community Center. That will be on June 24th from 9 to noon. If you want to get 50% off, there's a code right there on the screen, Megatrends, and that will get you half off your attendance ticket for that event. That is available until the 16th, and we look forward to seeing you at that event. One of our first in-person bigger events that we've done ever since COVID happened. So we look forward to seeing you all there. And without further ado, that is all my announcements for today. I just want to say thank you again to all of the speakers that are here, all the insurance experts that provided their knowledge for us, and for all of you attendees for joining us.
Thanks. Have a great one.
Thanks so
We'll stick
much.
around for a couple minutes. So
Yep. If you have any questions for Echo personnel, we'll be in chat for the next 10 minutes or so, and we can answer some questions if
thanks,
you have
Kevin
anything.
and Christy
Thank
and
you.
Bridget.
Okay, goodbye, everybody.
Everybody. So
Bye,
thanks, everyone.
Kevin.
Bye.
Bye, Christy.
Yeah.
Bye, Bridget.
Great job, Connor and David.
Okay.
Thank
Okay,
you,
bye.
Kevin.
Thank you, Connor, for your help also. Bye.
No problem at all. Bye, Joe. Thank you for coming.
Connor,
Is that Kay? Yes, Kay. What
It's
can I
Kay.
do for you?
2 questions. For the Campbell event, we're still registering through Everbright, right?
Yep. If you do not want to register through there, we do have an alternative means, but it's on a person basis.
Yeah,
So-
because, yeah, I was just double checking because besides getting the half price, they still charge the ticket price, the
Yep. So
processing charge.
if you want, Kay, just shoot me an email and I can help you out.
No, I registered. It's not a big deal.
Okay.
I just wanted to make sure because
Yes.
I noticed the new website, but I
Yep.
can't get logged in.
Yep. We're in the process. George is there nodding his head. We actually had an email discussion prior to this meeting. So the login process has changed, actually. We're actually fixing with our new AMS, we're able to do an SSO between our database and the website for the first time ever in Echo's history. So you'll actually be able to edit your own account and your information in there and your email addresses and all that. We're just going through the last couple kind of fixes. We needed the website to go live before we could do some of this more intimate troubleshooting. We plan on launching the website to the membership in a few weeks here, like 2 or 3 weeks. You'll get an email that says, hey, log in. You can edit all your information and see where you stand with your memberships and, XYZ.
Okay, so the echo.org is still going to be the same and you can't get to the old website and you can't get to the new website. Is that what I'm hearing?
No. So the
No.
website you're viewing on Echo.org is the new website.
Right, but you can't get logged in.
Correct. So the part that I'm talking about is actually your profile.
No,
Currently, there's nothing locked behind the login on the website.
yeah, no, I get that. So we can't get to the old website and we can't get to the new website.
You can access the new website. You just can't get to our database of
Our record database.
Our membership database you can't get to. What you're gonna
Yeah,
be able to
it's-
do, what you're gonna be able to do as soon as Connor fixes the link is go from the website directly into the database. The way we've done it in the past, it's been 2 separate systems and we've had to do it manually.
Okay, so when I type in echo.org,
Mhm.
it gives me a message and I put in my username and password. It says identity provider account not found for this user.
Oh, that's weird.
Well, no, that's correct because the login, so your old login is tied to our old website. You're going to get a brand new login when we send it out to the membership.
That's why I said we can't get to the new website.
Correct.
We can't get to the old one. We're sort of locked
We're in
out.
limbo.
Everyone will receive a notification
Correct.
to
Right,
re-register.
right.
Correct.
So we
I
can't
guess.
get to either website right now.
Yes, but we're on
That's
our
my
current.
experience.
That is correct, but our current website doesn't have anything locked behind your profile, so there actually is no need to log in at this time.
Gotcha.
That's
We-
usually
we
where
did
I
that on
go to
purpose.
look at upcoming programs.
Yeah, you're
Events.
you're completely fine to do that without logging in. We actually removed anything that was a barrier from the website when we did this transition. So you actually can go to our website, you can browse it like you've normally done it without the login. When we reinstitute the login, that's when we'll start putting some of those barriers to entry back in.
Okay,
So right now, you don't need a login to get any of the content on our website. It's designed like that to make it as seamless as possible. You can go there, you can still do everything you're used to doing. You'll get an email that says, hey, go make your accounts. We'll see it, make sure everyone makes an account. And we'll do a couple email reminders here or there. And then those procedures to kind of block off some of that content will start coming into place probably a few months down the line.
Okay. I thought maybe I was crazy because I couldn't log in.
No, you're not crazy.
Hey,
don't
you know,
We don't
Gee.
know. We don't know. Maybe you are too.
You will. George is absolutely right. You'll get another email that'll say, "Hey, our account process has changed. Click this link to go ahead and create your new password for the website." And that's basically all it'll be. And then you'll go in there and you'll sign in using those new credentials.
okay. That will clean up your database too.
Correct.
Yep.
The whole point of this is so people can go in and change stuff on their own, and we don't have to do it for them.
Yeah, but it will clean up who has membership.
That
Yep.
too, which is the other part of this whole shebang.
Yeah.
Is we need people to know who has a membership and who doesn't have a membership.
All right. Thank you.
Mhm.
Take care now. Goodbye, everybody. I'm gonna log off here.
We have a couple other people here. Phyllis, I do see your question. I'm going to go ahead and put a link. Oh, it won't let me. It won't let me put a link to the PowerPoint in chat anymore. I wonder why that is. Let me see here. I think I need to change this setting.
Great meeting, Connor. I'm gonna sign off.
Yep, thank you, George.
Yes.
I'll be in touch in the next couple day
Excellent.
or two.
Okay, take care.
Bye. Phyllis, if you don't mind, would you be able to put your email in chat? I'll just send you an emailed copy of it. Won't let
No
me add
problem.
it. Won't let me add it to the Zoom meeting for some reason. Oh, it's back.
Oh.
I can add
Yeah.
something now.
Okay.
Here, I'll go ahead and put it in Zoom. So there's a PDF copy of the slides. If you just click it, it'll download it onto your machine for you. I see there are a couple other people here. Is there any other questions I can help anyone with? Okay, if that was it. Phyllis, are we good on your end? Okay, I'm going to go ahead and close the meeting down. Thank you for those who are still here for coming, and I'll see you at the next event.